Chapter 8, Fiscal Policy, Deficits, and Debt. Discretionary fiscal policy consists of deliberate changes in government spending and tax collections, designed to achieve full employment, control inflation, and encourage economic growth. Expansionary fiscal policy increases aggregate demand. Contractionary fiscal policy lowers aggregate demand. Non-discretionary fiscal policy includes changes in taxes and government spending that occur automatically, independent of congressional action. Non-discretionary fiscal policy is also called passive or automatic. When the economy is in recession, expansionary fiscal policy may be in order. Expansionary fiscal policy is an increase in government spending, a decrease in taxes, or some combination of the two for the purpose of increasing aggregate demand and real output. If the federal budget is balanced at the outset, expansionary fiscal policy will create a government budget deficit. We can use the ADAS model to describe expansionary fiscal policy. Suppose initially aggregate demand is 81 and the economy is at full employment level. If aggregate demand falls and prices are sticky downwards, recession will follow with output falling below potential. Expansionary fiscal policy will increase aggregate demand and therefore restore full employment. When demand pull inflation occurs, contractionary fiscal policy may help to control it. Contractionary fiscal policy is a decrease in government spending, an increase in taxes, or some combination of the two for the purpose of decreasing aggregate demand and halting inflation. If the federal budget is balanced at the outset, contractionary fiscal policy will create a government budget surplus. Non-discretionary policy is a combination of built-in stabilizers. A built-in stabilizer is anything that increases the government's budget deficit or reduces its budget surplus during a recession, and increases its budget surplus or reduces its budget deficit during an expansion without requiring explicit action by policymakers. Examples include personal income taxes, payroll taxes, corporate income taxes, sales taxes, and excise taxes. Reductions in spending are desirable when the economy is moving toward inflation, whereas increases in spending are desirable when the economy is slumping. Built-in stability has reduced the severity of business fluctuations. We can use the graph to see how automatic stabilizers arise. Suppose the economy is at full employment GDP 2, and the budget is balanced at this point. Government spending will be the same regardless of the level of output, but taxes will be higher the higher the output. When output falls below potential, taxes fall below government spending, and a deficit arises, automatically increasing aggregate demand. When output is above potential, taxes rise above government spending, and the surplus arises, automatically lowering aggregate demand. In evaluating the status of fiscal policy, we must adjust deficits and surpluses to eliminate automatic changes in tax revenues. The standardized budget or full employment budget is used for this purpose. The standardized budget is a measure of what the federal budget deficit or surplus would be with existing tax rates and government spending programs if the economy had achieved its full employment GDP in the year. The standardized budget deficit is 0 at the full employment output level. If the economy slides into a recession, the standardized budget deficit is still 0 because government expenditure equals the tax revenue that would be forthcoming at the full employment GDP. The deficit that arises in a recession is a cyclical deficit and is not caused by government discretionary fiscal policy. A cyclical deficit is a federal deficit that is caused by a recession and the consequent decline in tax revenue. We can use the same graph that we used for built-in stabilizers to analyze cyclical deficit. When the economy falls into recession, taxes fall below government spending. And even though the fiscal policy stance is neutral, there is a cyclical deficit because government spending is higher than tax revenues. If the government chooses to further stimulate the economy through expansionary fiscal policy, for example through a tax cut, tax revenues will fall further and the deficit will be larger. Standardized deficit is then the difference between actual deficit, 500 minus 425 equals 75 in this example, and cyclical deficit, 500 minus 450 equals 50. Standardized deficit in this example is 25. There are a number of problems that arise in applying fiscal policy in practice. First, there is a problem of timing. Fiscal policy is subject to recognition lag, administrative lag, and operational lag. There are also political considerations that may lead to political business cycles, situations in which there is expansionary fiscal policy before the elections and contractionary fiscal policy after the elections. If consumers believe the policy is temporary, they may choose to smooth consumption and not respond to fiscal policy. State and local governments frequently offset federal fiscal policy with their own pro-cyclical fiscal policy. The crowding out effect may decrease private investment caused by higher interest rates that result from the federal government's increased borrowing to finance deficits. The national or public debt is essentially the total accumulation of the deficits minus the surpluses that the federal government has incurred through time. Deficits have emerged because of war financing, recessions, fiscal policy, and lack of political will by Congress. The total public debt represents the total amount of money owed by the federal government to the owners of government securities. U.S. government securities are Treasury bills, Treasury notes, Treasury bonds, U.S. savings bonds, and I-bonds issued by the federal government to finance expenditures that exceed tax revenues. This graph shows actual and projected federal budget balance between 1994 and 2014. We can see that during the late 1990s, the budget went from deficit to surplus before going again into deficit in 2001. It is projected to return to surplus in 2021. In the meantime, the debt is accumulated. Public debt is a burden on the economy. The annual interest charge accruing on the bonds sold to finance the debt is the primary burden of the U.S. debt. However, the large U.S. debt does not threaten to bankrupt the federal government, leaving it unable to meet its financial obligations. One reason is that the public debt is easily refinanced. Another reason is that the federal government has the option to impose new taxes or increase existing tax rates to finance the debt. Other important considerations associated with public debt are as follows. Ownership of the public debt is concentrated among wealthier groups. A large public debt may impair economic growth if higher taxes for interest payments on government securities dampen incentives to bear risk, to innovate, to invest, and to work. External public debt, or the part of the public debt owned by foreigners, is an economic burden to Americans. Financing of the large public debt transfers a real economic burden to future generations by passing a smaller stock of capital goods onto them. Who holds the U.S. public debt? 53% of the debt is held by the federal government, 44%, and the Federal Reserve, 9%. The rest is held by U.S. individuals, 7%, U.S. financial institutions, 8%, foreigners, 25%, and other institutions such as local and state governments. The most significant fiscal issue in the U.S. is the long-term funding imbalance in the Social Security and Medicare programs. There is a severe long-run shortfall in Social Security funding because of growing payments to retiring baby boomers. The accumulation of monies in the Social Security Trust Fund will be greatly inadequate for paying the retirement benefits to future retirees. The problem is one of demographics. The percentage of the American population age 62 and older will rise substantially over the next several decades.